Hey there, and welcome to another episode of the Pure Property Podcast, where we talk about all things property and property investment. So, Matt, how's it going your end? All good?
Yeah, all good. Absolutely fine. Busy time of year, isn't it? I think we look at the likes of last year, it was absolutely manic.
Yeah,
so I
this
think we're
period.
coming into that period now where summertime, I think the sun's out. Obviously, it's coming into early summer.
This year has flown by.
It's flown by, but I think people,
scary.
I don't know, I feel like you get a bit of a buzz of like people want to buy and sell. It's a little bit more activity we always see at this time of year in the market.
Yeah, I think what's quite interesting is obviously I have got estate agency background, and in estate agency background, like this time of year we're going into tends to slow down. You know, people going to school holidays and stuff like that. We see the opposite in terms when you're looking at just an investment point of view. Like people are still on it, which is good to see. So yeah, hopefully it'll be a busy few months.
Yeah, hopefully just like last year.
And hopefully we can get some sunshine to go with it.
Yeah, let's hope so. We know what the UK weather's like. It's not always the most consistent.
Yeah, exactly that. But yeah, on this week's episode, we're going to be covering why it's important to diversify your property investment portfolio. It's something that we will often discuss with our clients. You know, if they're looking to build portfolios, or maybe they've got quite a big chunk of capital sitting there they want to invest. You know, we will always broach the subject of diversification. So let's head into why would you say it's important to diversify, Matt?
I think I know it's an old saying, but try not to have all of your eggs in one basket. I know that is a very classic way of obviously what people have said in the past, but I do generally believe it's true.
Yeah.
I think if you diversify, if worse comes to worse, there was a certain area or something was to happen there, it could potentially affect maybe the properties in that area if you've got all of your investment properties in one location, or maybe you could even, the diversification could be anything. It could be the likes of having houses to apartments. It could be the likes of location. It could mean a lot of things. So I guess we'll go over a little bit more detail of exactly how that could look. But I think it's massively important, I think, to anyone's, I think if you're I would say a savvy investor, I think diversification, whether that be not only in property, but I think across the board with investments,
stocks, ISAs,
you should maybe look to spread just in case for a rainy day.
Well, that ties in nicely with what I was going to say. First of all, it's like it's risk reduction, isn't it?
Absolutely.
Because when different markets fluctuate, you know, if you've got investments, like I'm speaking now on property investment terms, if you've got property investments in different sort of markets, sort of across the country, whether that's by property type or property location, you know, your risk is reduced when there are market fluctuations in certain areas.
Yeah.
So that does help reduce that risk, because you have to remember, like, not every location acts the same at the same time. You know, we're seeing it with London at the moment and the Northwest.
We think about if you were to buy a property in London 10 years ago, and you was also to buy a property in the Northwest 10 years ago,
they'd be acting differently.
You'd have been laughing at your London one because it would have probably done really well.
Yep.
But now your London one's going to probably be a little bit more stagnant, and the Northwest is taking off. So that one's now doing really well. So prime example of, you're kind of seeing the best of both worlds and having that risk spread out.
And look, that also goes on to sort of stability and growth, because great scenario you just picked up on there. If you got a property in London you bought 10 years ago, and you bought a property in Manchester, yes, you're correct. Obviously, London would have taken off and would have been doing really well, and you'd be like, brilliant. And your Manchester one would kind of just be like ticking along. But now flip the script 10 years later, it's doing the opposite. But you will still, over that 10 years, be okay, because you've had the growth in London.
Yeah.
Now you're getting the growth in Manchester. So you've got more stability and growth going on within your portfolio, because you've spread out the locations. You know, when one place is doing better than the other, you're still going to benefit because you've got one in both.
Exactly that. If you would have bought maybe, as we said, 2 in London, you would have been absolutely happy with it. But now maybe you might be thinking, I'm seeing Northwest and Northeast and the Yorkshire and Humber area do well. Maybe I should have sell one of these and buy up there, because, as you said, if you've maybe got that diversification from the get-go, it kind of, I think it just causes less issues for you as well. And definitely in your mind, it's a little bit more, I think, mentally calming. You've got the options elsewhere.
So maximising returns That's another reason why you do it, because yeah, a bit like location and like we just mentioned there, like property type, like you might have a city centre apartment, which could be doing absolutely amazing at a certain point within maybe the regeneration or the cycle of the city centre. But then you might think, well, actually, you might have a couple of apartments, but let me now look at a house. It's not going to be city centre, but this house is going to be in maybe like a more semi-rural location or just outside of city centre. So again, both of those, if you've got one of each, they'll both perform quite well in their own way, and maybe at different times as well in different parts of the cycle.
Got the ripple effect, haven't you? From where maybe the city centre, it was booming at the start, but now the place on the outskirts of the city are now. I mean, we look at Manchester as a prime example. You're looking at the M1, M2, M3 postcode. They've seen major growth over the last couple of years, but now you look at the likes of the outskirts, which is Trafford, the Media City area, which is now being the area now that everyone's going, this is where I need to invest because that's where the growth's now happening. Yeah,
and also like diversifying the portfolio. You wouldn't have a city centre apartment and a house. You might say it's diversification in terms of the actual type of property, but it's not massively because they're both in the city centre.
Yeah.
They're not going to both perform the same within the city centre realistically.
No.
You know, city centre people are more geared towards the flats, not the houses. So that's why, again, just having the house in a different location, semi-rural outside the city centre, that's how that diversifies and will help to maximise your returns. And lastly, it just means you're able to adapt. So when there are fluctuations, when there are changes in the market, being diversified within your portfolio and when you purchase means you are then able to adapt to different market conditions. And it's something we've spoken about. I mean, we talk about it all the time, not just diversifying portfolios in terms of when you are looking to invest, make sure you're able to adapt to different markets and go to different locations, which are doing the better, if that makes sense.
Yeah, I think as well for some people, not always, but I think it maybe gives them the peace of mind that maybe in the future, once they have one of each, maybe a house and an apartment, for example, one in the city centre, one on the outskirts of the city or a town, or at least, you might think, well, I actually prefer the housing route because it maybe causes me less issues, or you might prefer the apartment because of the hassle. So in regards to that, I think it also can make you understand, because everyone's different. Everyone likes certain investments for particular reasons of their own and views of their own. So I think it can also help understand what maybe you like personally and what suits your investment needs.
Yeah.
Whereas before, if you didn't know that and you were just going down one route, you might never know that option could be something that you actually prefer. And then in future, you might just stick to houses on the outskirts of the city.
Yeah, I think that's why it's important as well to make sure that you're not just like a lot of people say, oh, I want to invest in a house, but a house in a certain location or a type of house might not do well. Like some people think just getting a house means, oh, I'm going to get capital growth. Well, no, because if the type of house you buy in that location doesn't fit a good investment criteria and fundamentals, it's not going to perform as well.
Yeah.
Like Frossall Nest, for example, the new one we've got in Yorkshire, that is a great option because of the type of property it is for that area. They're luxury, high spec houses in a good location, smack bang in the middle of like 2 golf courses, schools, they attract families. They're the type of houses which are going to perform well in terms of capital growth. Yeah. Not maybe like a small 2-bed terraced house. And again, in that area, you're not going to be looking at flat. But then on the other side, when we've got Langdale Mews, that Manchester development that we sold. I think we've only got like 2 units left in there, but that works well for there because it's near it's 6 minutes to Piccadilly, Manchester City Centre. That is ripe for, tenants looking to commute in. So rental growth and capital growth is going to be great there as an apartment in comparison to maybe some other property types as well. So again, it's just making sure you're not just fixated on one type of property and you're picking the right diversifying for the right correct area and location.
Absolutely.
Yeah. And then look, in terms of strategies that you can use for property investing and going over the sort of risk tolerance and goals for the different type of strategies. So when we're looking at diversifying in property investment alone, we're not going to talk stocks and shares and ISAs and bonds, etc. We'll focus on the type of investment and the risk factor involved. So let's start with obviously the main one if you're looking to invest, is your vanilla buy to let. In terms of risk, it's pretty low to medium level.
Yeah.
You know, you just buy a residential property to rent out to a tenant.
Yeah.
It's pretty as simple as that. It generates steady income. You'll get capital growth. You know, if you pick the right location, you might get a lot better capital growth than others, but it's a nice
do any work to it.
No, pretty hands off. Yep,
Yeah.
exactly. So in terms of risk level, that's low to medium. Then you might look at something else if you were to diversify, such as HMOs, which stands for houses in multiple occupancy. So what would you say the risk level is for those?
I think in terms of that, you need to weigh up the options with the HMOs. Like, as we know, it can be very, very profitable. But at the same time, maybe if you've got a room or two that isn't occupied for a certain amount of time, you might be in a loss or something like that. So you do have to, I think, weigh up your options, look into the demand. It can be quite a high risk strategy, and there's a lot of effort and time that goes into that. It's not as straightforward. I think a lot of people see HMOs
See the
as
outline
their golden
numbers.
ticket.
Yep.
As like, wow, this is the best way to make. And look, it can be very, very lucrative if you find a real gem, which is becoming harder and harder nowadays, isn't it?
Well, there's like more sort of hassle and management because you're managing rooms. So you've got in one asset, so one house, you might have 5 rooms. You've got to manage each of those rooms, each of those individuals. So that's a high risk.
Which they might not get on with each other. They might have issues. Then you're the one having to deal with that.
Stricter regulations. So in terms of actually kitting the house out, you have to be having correct regulations for it because you've got multiple people in one house. It may need licensing. So if it's in an Article 4 area, you'd have to get planning permission as well from the council to convert it.
More than, what is it, 4 bedrooms, I think it is, they have to?
Yeah. So, well, it's anyone three or more occupants non-related, then it becomes a HMO. So, and then you have to remember, obviously, the refurb work that goes in, the constant turnover. You know, if you've got rooms being rented out and if the turnover may be quite high, that's quite high risk. And you mentioned it, you know, you're renting out rooms. It takes 1 or 2 rooms to be empty and you're then maybe not making any money and maybe losing money. So again, that's where we look at it being probably more on the high risk side. In our opinion, don't get me wrong, for some people, it can be a great strategy, and people that crack the HMO code, if they know what they're doing and they're very experienced in property,
it depends
and HMOs.
how risk adverse you are. I think, look, for diversification at a later stage, once you've maybe got buy-to-lets in the portfolio, it's a bit different. But I think, as maybe your first investment, I think it's... For me, I wouldn't be going there for my first one for sure. Yeah.
Then you got commercial property. So these would be like maybe where you buy a building and, you know, maybe offices, maybe retail, maybe shops, and, you know, maybe a barber or a hairdresser, something along those lines. Now, I would probably class them in the category of medium, maybe just a bit higher than medium. And the reason I say that is they can be very good because the tenants go in, they're fully repairing leases. What that means is, you know, the tenant that goes in has to look after the whole building, whatever they own, whatever they're sort of leasing from you, they have to look after all. So if they're leasing the whole building, they have to look after the roof, the outside, everything. You like, from a maintenance point of view, very low level. You can do very well because tenants stay in a long time as well. So the turnover of tenants tends to be lower. The reason I'd say it's slightly above medium is because, one, we are seeing a lot of commercial property sitting empty now, just the way, you know, the market trends have changed. You know,
a lot of businesses have moved to online, haven't they?
Exactly. So a lot of shops are sitting emptier more than they used to. We are seeing it get better since the pandemic, but it's not where it was.
Encourage it more, aren't they?
Yeah, and then obviously talking about the pandemic, for example, external, like worldwide and economic circumstances can heavily affect the commercial market because, you know, a business will be like, oh, we're shutting up shop, we don't want the overheads for moving out. Look, tenants need a place to live. They're always going to need a roof over their head. So even in hard times, yes, it'll be a struggle for them, but they need a house. So you should always have that constant demand. That's why I just say medium, slightly above medium is what I'd say. Flipping, what would you say about flipping?
I think we get quite a lot of this, don't we? Especially for people that, I think it, once again, is made out to be a lot easier.
Well, why don't you explain what flipping is then?
So obviously, flipping essentially would be as if you were to go in, buy a property, maybe one that probably most likely does need doing up. And then at the end of that, trying to get a valuer to go in there and value it at the price that you realistically would like it to be, and then sell it for a profit on top of that. Look, some people do end up I guess doing buy, refurbish, refinance, and then renting out. So you can rent it out after and pull some of your money back out, which is a very similar model anyway. But I think it's personally quite high risk because, especially today, with I think valuations going on,
A lot can go wrong.
a
Bad
lot can go wrong.
contractor, bad.
Exactly. It could be down to a number of
Can't
things.
sell it afterwards if you buy it in the wrong location, or maybe you uncover loads of work. And if you haven't got,
It could be a headache for sure.
if you're not doing the work yourself, or you haven't got a solid contractor or construction team or builder or whatever, it's very, very high risk.
Yeah, you do need a good team of people around you.
Good potential returns, but very high risk. In my opinion, you have to know what you're doing. You're going to have to be, especially in the early stages, quite hands-on. I'm not saying doing the work yourself, but hands-on in terms of project managing, looking over it all. There's a lot of moving parts within it, and for me that just makes it high risk in my opinion.
For sure, and if it doesn't get the value that you want it to be, then you end up potentially being in a negative or actually losing money.
Yep. Another one is holiday lets. So this is where you might rent it out on Airbnb, Verbo, whatever that might be, Booking.com. And this is where you'll rent it out on a nightly basis rather than they call it holiday lets because obviously a lot of people are using these holidays. But you may get them people just maybe companies need to put their workmen up for a few days, few weeks, maybe a couple of months. They'll go down this holiday let room where they'll rent it out on a nightly basis. In my opinion, again, it's probably medium to high. Returns can be very good, but high risk because, look, if it goes wrong, it's quite costly.
There's no guarantees there on what occupancy you're going to get every single
fluctuations.
Month. If you're buying in areas as well where it's seasonal, you might in the summer do amazingly well. In the winter, you're trying to get absolutely anyone in there.
It's only I would actually sort of bring it more sort of medium, and it can go into the low category realistically, as long as you're picking an area where you can flip both. So like a city centre location, you're definitely bringing that risk down because
I know one of the locations as an example when we had a property in York.
Yeah.
One of my clients is in one of the developments there.
I would consider that low risk,
For a short-term let in that model and holiday lets, the company that actually manage it for her have had properties in that area, and they said for the past 3 years, across the whole year, they normally have around an 84% occupancy rate for 12 months of the year, which is amazing, really, really solid figures. And if you've got that in place and it's a good location, as you said, you have to make sure, I think with holiday lets, the location's key. You can't be doing it anywhere.
Exactly.
But if you've got a management company that are good and they take care of your property and look after it, then it can be massively lucrative. As you said, I'd probably say it's around the medium.
Another one, I won't go too much into this, but development. So property developing, it is very high risk. Good rewards, but very high risk. You've got to buy the land, you've got to tie a lot of money up, you've got construction
involved, isn't it? You need
big financial burden. You need to have good contractors. There's a lot can go wrong, but there's a lot of money to be made. So I'd class that as high risk. And then the other one would be off-plan investing. So, and again, which can range. It can go quite, because off-plan can be, before a shovel's been in the ground, up until like a month before completion. Like Frostle Nest, for example, is pretty much ready. So it's very low risk in our opinion. So that would be a sliding scale. And also the developer, the funding, the site, the location. There's a lot. So that would be the other one. It
varies from site to site, doesn't it? If you're looking at a development that this is their developer's first site they're building, they've got no funding, they're relying on investors' funds. It's different. If you're going with a seasoned developer that's been in the industry 30, 50 years, they know what they're doing, we've seen maybe their quality and finish, then you might look at that as low risk. So
so I mean, overall, that's the ones that we would deem like the sort of straightforward ones within property. So when looking to diversify, that's what you'd potentially be looking at. And each strategy has its own risk profile, which you have to consider for you personally as an investor. And what I always say is, when you start with one of those strategies, doesn't mean you're going to stick with that forever. Like some people do expand or shift into different strategies. Like someone might start off buying just buy to let. So they build up maybe 2-3 in their portfolio. Then they might say, well, actually, I've got that steady now. Let me try holiday lets. They quite like holiday lets. And they're like, okay, a couple of those. Now I'm going to try HMOs. And then they'll have HMOs. They're building up the experience and building up the sort of risk tolerance and being able to deal with it by going up the level. And then they might go, well, actually, look, I've done buy to lets. I've done holiday lets, which is successful. Now I've done HMOs, which, I had to do a lot of refurb work in that. I'll tell you what, let me give my hand a little bit of development. They might buy a small site, develop it out, or maybe it's like a commercial to residential conversion and develop that out, and they'll move along the strategies like that. But along the way, they're diversifying their portfolio.
I think it depends massively, I think, as well on the individual.
Yeah.
How much they want to dive into it, if they might have a full-time job and buy-to-lets. And
that's
as you said,
yeah.
that the holiday let route might just be that's it. But as you said...
That's an example of how you can transition.
Oh, absolutely.
Like
I think you can go into any of them.
Not everybody does that, but what I'm saying is a lot of people get hooked up on, if I do one, I can't do another. No, you can. Just have to manage it correctly, manage it within your risk profile. And like you said, experience and time is a big thing as well.
Yeah, absolutely. No, I think it comes down to yourself and what you feel comfortable with doing. And maybe I think a lot of the time people do start on the buy-to-let route just to have that stability in place and look into things. Then in the future, you can then expand the portfolio. And as we've talked about in this episode, diversify. Look to maybe have certain properties where look, the buy-to-lets, you've got a very steady income of maybe the 2 or 3 that you've got there. Why not try the short-term lets where even if there's a couple of drier months, you've still got that secure income in place with your buy-to-let. So that's options where you can maybe think, you know what, I'll take that risk. Yeah,
look, I mean, when you are looking to diversify your portfolio, as we said, it's important for the reasons we spoke about at the beginning. Risk management, returns, all that sort of stuff. But when you are looking at diversifying and, you're looking at the different strategies to diversify into, it's always imperative and important that you look at your financial situation, your risk tolerance, and your strategy at that time. What's going to fit your investment strategy at that time before making a decision what to diversify in, and also what strategy to pick. So that would be my big advice to end on.
Yeah, I'll just back that as well and just say the exact same thing, reiterate that. I think, it comes down to you. If you're happy doing it, then do it. And as I said, always try to get advice from maybe an expert to make you feel maybe a little bit more at ease, or they can at least weigh up the pros and cons to both sides, and you can then make an informed decision off the back of that.
Good stuff. Right. Hope that's been another good episode, and we'll see you on the next one.
Take care.
Cheers. Bye-bye.